You might have had big goals on January 1st. New budget, no debt, and investing every paycheck. And then work happened, kids happened, winter happened, life happened. So if your January hasn't gone perfectly with money, you're exactly who this video is for. Here we are on January 31st, and I want you to treat this day as your real financial New Year's Day. In this video, I'm going to walk you through a clear, practical annual money checklist for all Canadians. It'll be a step-by-step sequence you can run once a year to reset, realign, and finally move forward. If you're new here, I'm Yudhvir Kabuli, CPA and CFA, and a fellow Canadian just like you, trying to make smart choices in the same system you are in with my money. So here's a quick reminder before we dive into today's video. This is education, not personalized financial advice. Before making big changes, please talk to a professional who knows your numbers. Alright, grab a tea or coffee, open your notes app, and let's finally do your January reset. Step 1, net worth report. This is your one-page snapshot. We're starting with a quick net worth report, basically your personal balance sheet. Open a notes app or just a simple spreadsheet and create just 4 lines. Line 1, this is cash and short-term savings, checkings, emergency fund, plus any high interest savings that you have. Line 2, all your investments, TFSAs, RRSPs, FHSAs, RESPs, non-registered accounts, and any corporate accounts if you have them. Line 3, we're talking debt, credit cards, line of credits, car loans, student loans, and a mortgage. Line 4, this is your net worth, assets minus liabilities. If you did this last year, put last year's numbers in a column right beside this year's. And there's no judgment here. None of that I should be further ahead thinking. This is pure data. This gives you your first year's KPI, your true starting net worth. And it shows whether your last year's decisions moved you forward, backwards, or just sideways. You cannot manage what you never bothered to measure. Step 2, build a 12-month cash flow map. Now we're moving from balance sheet to cash flow forecasting. Look at last year's statements from your main checking account and your main credit card or 2. Roughly group your spending into 3 different buckets. Bucket 1, these are your fixed costs, rent or mortgage, insurance, phone, internet, transit pass, or a car payment if you have a car insurance on that, gas, and basic bills. Bucket 2, think of your variable costs, groceries, eating out, shopping, kids' activities, and having fun. And finally, bucket 3, seasonal costs, car repairs, school expenses, holidays, travel, paying that property tax, or any fancy membership renewals. Now, look forward at this year. Are there any changes coming up in your income? Is the rent going up? Is your childcare starting or ending for the family? Any big known expenses coming? Are you planning a move? Want to buy a new car? A wedding? A course or a renovation? All we're doing here is building a simple picture. Here's what usually comes in, and here's what must go out. And here's what tends to sneak up on me. So the goal isn't a perfect zero-based budget. No, it is a realistic cash flow map so that every other decision you make after watching this video matches your actual life, not just a fantasy version of it. And step 3, set this year's savings and investing targets. Now that you've seen your cash flow, we can set some KPIs for your money. You just need 2 numbers. Number 1, a percentage of your after-tax income. And number 2, translate that into a dollar amount for the year. Take this for example. This year, you want to save 15% of your take-home pay and put it towards savings, investings, and debt pay down. Maybe that works out to about $12,000 for the year. Then, simply just break it down. Per year, per month, per paycheck. So that $12,000 for the year would look like $1,000 a month and $500 on every bi-weekly paycheck. This is not a vague, I should be saving more. You're just choosing a hard number, your savings rate KPI for the year. And we're going to plug that number into your accounts in the next steps. Step 4, debt and interest rate review, your capital structure. Now, we're going to flip to the liability side and look at your capital structure. List every debt you have, credit cards, line of credit, car loans, student loans, and a mortgage if you have a house. Besides each one, write down the balance, the interest rate, and the minimum payments you have to make. Then, I want you to ask yourself 3 questions. Question 1, is anything here above say 10 to 12% in interest? If yes, that is a priority. High interest debt is often the best risk-free ROI you'll ever get by paying it down. Question 2, is your mortgage coming up for a renewal in the next 12 to 18 months? If so, what would your payments look like? at today's rates with a little stress test buffer on top. And question 3, does consolidating at a lower rate make sense for any of your debt balances? Your January reset is the time you get to decide which debt gets the spotlight for this year, so that you're not just scattering extra payments everywhere and actually going nowhere. Step 5, credit health check, your cost of capital. Next, we look at your credit profile, the thing that quietly sets your cost of capital. Once a year, treat this just like your annual medical checkup. Pull out your credit report from the major bureaus like TransUnion or Equifax. Look for accounts that don't belong to you, any old issues that should have been dropped off by now, and utilization problems. Maybe one card is close to maxed out, even if your total limits are fine. If something looks wrong, start the process now to dispute it. If utilization is higher than it should be, see whether you can spread balances more evenly or aggressively pay one card down below that red zone. And this isn't about chasing a perfect 900 score on your credit score. It is about keeping your borrowing costs low in the future when you will eventually need credit for something important. Step 6, tune up your payroll and employer benefits. Now, we move to what I call your HR stack. Once a year, do a quick employer benefits audit. Ask yourself, are you contributing enough to get the full match on any RRSP, pensions, or stock plans your employer offers? Because leaving match money on the table is basically you turning down free 100% ROI. The second question you have to ask yourself is, do you have optional benefits that you're paying for, but you're not actually using? Has your money situation changed so that health or dental coverage need to be updated this year? And the next thing I want you to look at is your payroll withholding. If you owed a big amount last year, maybe you need to increase withholding on your TD1 forms this year to smooth out monthly cash flows. If you get a huge refund every year, maybe you were over withheld and you can bring in a bit more cash flow into each month instead of a lump sum refund. Yes, it is boring paperwork, but it is boring paperwork that can easily be worth hundreds or thousands of dollars over a year. Step 7, account architecture and contribution penalties. Now we can clean up your account architecture. I want you to log into CRA My Account and check your TFSA room, your RRSP room, your FHSA status if you're a first-time homebuyer. Then log into each bank or brokerage where you have such accounts. TFSA, RRSP, FHSA, RESP, non-registered, and corporate accounts if any. Ask yourself, do I have accounts sitting in cash that were actually meant to be invested? Do I have tiny orphan accounts I could consolidate to simplify my life and declutter? Is there any chance that I've overcontributed to TFSA, RRSP, or FHSA and need to fix that before the penalties start piling up with interest accruing? Then set your contribution waterfall, the priority order for new money this year. A totally hypothetical but doable example. Number 1, TFSA contributions up to your target. Number 2, FHSA if you're a first-time homebuyer. 3, RRSP, especially if you're in a higher tax bracket. Number 4, RESP if you have kids and that available extra room. Your exact order actually depends on your goals, but by the end of this step, you should know exactly which account gets your next investing dollar. Step 8, plan your RRSP move before the panic. The RRSP contribution deadline for last year's income always feels like it's showing up out of nowhere at the end of February. So instead of scrambling mid-month in February, decide now. Ask yourself, at last year's income level, what was your marginal tax rate? Was it high enough for an RRSP deduction to be powerful this year? Or are you still in a relatively low tax bracket and would like to defer the contribution deduction? And I also want you to ask yourself, if you do contribute towards your RRSP and get a refund, what will you do with that refund? Invest it? Pay down debt, or boost your emergency savings? Please don't tell me the answer is to spend it away. Some Canadians are actually better off doing a smaller RRSP contribution now and giving more space to their TFSA. Others, especially those of you that are in your higher tax brackets, you can get a lot of value from RRSP contributions. So the key is this, your RRSP move should fit into your step 3 savings plan we covered above. I don't want it to be a rushed, everyone says I should do this, so I'm gonna do this as well, tax time FOMO for you. Step 9, please set up your tax season systems. Now, we're trying to help future you. Create a 2025 taxes folder on either your computer or in the cloud. If you like paper, make a physical folder of those printouts. Inside of it, I want you to drop any T-slips as they arrive, donation receipts, childcare receipts, RRSP contribution receipts, any records for rental properties or small businesses that you have. And please make a quick note on anything unusual that happened last year. A big capital gain, the sale of a property, or maybe you started a new side hustle. And for those of the viewers that are self-employed or have rental income, please also reset your systems this year. Start a new mileage log, start a fresh spreadsheet or app to track your income and expenses from January 1st onwards. So the goal here is to turn tax season from a scramble into 2 or 3 focus sessions where everything is already in one place. Step 10, portfolio rebalance and risk check. Now we're going to look at your investments with a slightly more advanced lens. Think of this as your asset allocation review. Once a year, sit down and ask yourself, roughly what percentage of your invested money is in stocks, bonds, cash, and any alternatives that you might use? Does that still match your risk tolerance and your time horizon? What is your personal investment policy statement, even if it only lives in your head, but make sure it aligns. If stocks had a strong year, you might now be more aggressive than you intended to. Rebalancing simply means moving money back towards your target mix. That could mean pointing all new contributions towards an underweight asset class, or doing a few small trades inside the registered accounts where there is no immediate tax impact. Don't think of this as finding the next hot stock or sector. It's just about keeping your risk level where you chose it to be, not where the market drifted it. And we know 2025 has been stellar. Step 11, risk and insurance audit. Now we're going to stress test the whole plan we have so far with a basic risk management review. Once a year, ask yourself a simple, maybe uncomfortable question. If something bad happens, does my current setup blow up the whole plan? You don't have to love insurance. You just need it to be good enough for risk coverage. So review your term life insurance. Does that coverage still match your dependents and your debts? Review your disability insurance. If you couldn't work, what percentage of your income would actually be replaced and for how long? If you have critical illness coverage, does it still fit in your situation? And are you comfortable with the premiums? Then let's take a look at home and auto insurances. Are your coverage amounts and the deductibles still appropriate for your assets and your cash flow this year? So we're not trying to become an insurance expert at all. We're just looking for obvious mismatches after a year of life changes. Step 12. Pick your one big money move. Every year should have one headline win, not 10, just one. And we're going to call it your North Star financial goal. Here's an example. This year, you're going to eliminate all credit card debt. Or, this is the year you build at least 3 months of expenses in cash. Maybe it could be, this is the year you finally open your FHSA and fund it. Or this is the year you set up a DCA plan, a dollar cost averaging plan, and actually stick to it for the entire 12 months. Whatever your goal for 2026 is, pick one and put it somewhere you'll see it. Maybe on your fridge, your wallpaper, or even in your notebook. Everything else in this checklist is there to support that main storyline. Step 13, schedule your money dates. Good systems beat good intentions every time. This is where you put your plan on autopilot. Before you close your planner, book 4 money check-ins for the coming year. Late April, after tax season. Mid-July, mid-year review. Mid-October, your fall tune-up. And next January, your next full reset. And these don't need to be long. Even 45 minutes, once a quarter, is enough for us to revisit your savings and investing progress, any big changes in income or expenses, and whether your big money move for the year is on track or not. Put them in your calendar like appointments with your future self. Step 14, have one honest money conversation with your loved ones. This step isn't about spreadsheets. It's actually about behavioral finance in your real life. Money does not live inside of a spreadsheet. It lives inside your relationships. So pick one conversation this week with a partner about goals, priorities, and what enough actually looks like for the two of you. Or with your parents about their plans and documents. Or with your kids about the importance of saving, spending, giving, and how the credit system works. So the conversations don't have to be heavy to be meaningful. It just has to be real. Every year you're avoiding these conversations, tension is actually quietly building in the background. But every year you do have them, things are getting a little clearer for everyone involved in your family. And step 15, estate and succession plan. We'll close with the long game. your estate and succession plan. Estate and incapacity planning isn't just one and done. Life changes. Your documents must catch up. Once a year, ask, does your will still match your current family situation and what you actually want it to cover? Do you have valid powers of attorney for property and personal care in your province? Are the people named still the right people and your intended beneficiaries? Do your designations on RRSPs, RIFs, TFSAs, pensions, life insurance, and group plans match what you think they should be? And if you own any sort of business, does your succession plan make sense there? Things like shareholder agreements, buying and selling clauses, or even a basic plan for who's going to run the show if unfortunately you're not there anymore. If you added a child, unfortunately ended a relationship, bought property, or started a business last year, this step matters even more for you. So in this last step, we're not trying to build the perfect tax optimized structure. No, we're just trying to avoid leaving a maze and a mess for the people that you care about and that care about you. So that, my friends, is your January reset and annual money checklist as a Canadian. Here's a quick recap on your screen. Net worth report, cash flow map, savings and investing target, debt and interest rate review, credit health check, payroll and employer benefit tune-ups, account audit and contribution priorities, RRSP strategy before the deadline rush, tax season systems, portfolio rebalance and risk check, insurance and risk management audit, and one big money move for the year. Don't forget those scheduled money dates and have that honest money conversation. And lastly, an updated estate and succession plan. So I don't expect you to finish all of this tonight, the day you're watching this video. But if you chip away at it over the next week or two, your 2026 self will be living in a very different reality because of what you started today. If you want more Canadian specific no noise breakdowns just like this one, hit subscribe, tap like so more Canadians see this, and comment and tell me below, which item on our checklist are you going to tackle first? I'll be sure to read them, and I'm genuinely excited to see how 2026 pans out financially for you and your family. Once again, I'm Yudhvir Kabuli, CPA and CFA. Thanks for watching, and I'll see you in our next episode of The Canadian Dream, your Canadian personal finance playbook.